Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to discuss 4 future dividend kings that you can buy right now. Dividend paying stocks are one of the purest forms of passive income. You make your initial investment and watch the cash flow come in every single quarter without having to do any more work. And the 4 companies that we're going to discuss today have been growing that annual payment to their investors for decades on end. And all of these companies are fast approaching the honorable dividend king status of 50 straight years with consecutive dividend increases. So these are some of the strongest companies on the market. They've been operational over the long term and have proven that through good times, bad times, any recession or depression, not only can they pay out a dividend to their investors, but they continue to raise it every single year as well. So we're going to take a look at 4 different companies. They operate in very different sectors of the market. We're going to go over their current financials, the recent growth of each company, and of course, their dividend information and the dividend safety score. So for each of these companies, they all operate in very different ways, provide great growing passive income to their investors, and over the next few years, they will all become a dividend king. So before we take a look at that first company, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and the first future dividend king we're going to go over today is ticker PEP, which is Pepsi. They currently trade for $146 per share, and over the past year, the company has grown by 12%. One of the largest consumer brands in the world, with a market cap at $204 billion. They sit right now with a dividend yield of 2.9% and a forward PE of 24. And if we take a look over the longer term, this has been a very consistent company. Over the past 5 years, their share price has grown by 43%, and over the past decade, over 108% total share price appreciation. And under the Pepsi umbrella, they own 23 billion dollar brands. So 23 different brands owned by PepsiCo currently operate and generate more than $1 billion in annual sales, which is incredibly impressive. So this company is nicely diversified and is not solely reliant on 1 or 2 main brands to fund their future growth. And we can see that currently the company generates 55% of their revenue from snack foods and 45% from their different beverages. And they're the leader in the salty snack food category and are in second place, just behind Coca-Cola in the beverage industry. So this is a huge player in the food and drink market that's been operational for the long term, and I believe going forward, their well-diversified suite of brands will continue to generate growing revenue for many years to come. And if we take a look at the income statement, over the long term, PepsiCo continues to deliver growing results. The company's total sales continue to expand year after year to over $71.3 billion in the trailing 12 months. And the company has strong guidance to close out 2021 and into 2022. And if we take a look now at their dividend information, we can see they've been growing that payment for 49 consecutive years. So in 2022, when they increase their dividend once again, they will officially become a dividend king. And since 2013, that annual payment has been growing at a CAGR of 9%, with a current yield right around 3% overall. And if we take a look, right now their annual payout per share is at $4.30. Their net income payout ratio sits at around 70%, and for the past 5 years, they have a CAGR of 7.8%. And for this consumer brand, jumping over to Simply Safe Dividends, they come in with a very safe and a score of 93. So extremely unlikely that we see a dividend cut coming from Pepsi anytime soon. And this is one of the larger positions in my personal portfolio as well. It makes up 5.6% of the total value. I own 39 shares of this company, and Pepsi pays me $167 in annual passive income without me having to do any work for the company. So Pepsi is the first future dividend king we're going to take a look at in this episode. We all know the brand. I'm sure we've all consumed their products and their beverages. And going forward, I think Pepsi will continue to operate for long into the future. So their future dividend king number 1, they will be becoming a dividend king next year. And now moving over into stock number 2, we have ticker WMT, which is Walmart. They currently trade for $141 per share, and over the trailing 12 months, they have grown by 15%. Over the past 5 years, they're up 100% overall, and for the past decade, up 159%. So once again, a very boring company that I'm sure we all use on a weekly or monthly basis that continues to perform very well over the longer term. And right now they have a market cap just below 400 billion, a dividend yield of 1.55%, and a forward PE of 23.8. And Walmart just shared their Q1 results for 2021, and they absolutely crushed analyst expectations with a very strong quarter. And they believe that now as the pandemic is coming to an end, consumer demand has been pent up over the past year, and more people will be unloading their leftover cash into Walmart stores. And we can see in the first quarter, they generated $138 billion of total sales with earnings per share of $1.69. And what's really impressive is that their US e-commerce sales grew 37% year over year, which is absolutely phenomenal. And they believe that their e-commerce platform will continue to grow in the high 20 to 30% range annually over the next 5 years. And with Walmart, many investors love to ignore the company. They believe it's just boring and don't really look into the numbers. But if we take a look at their income statement, even for one of the largest retailers in the world, their total sales are continuing to grow slow and consistently every single year. 485 billion back in 2017, up to 500, 514, and so on to over $562 billion in total revenue over the trailing 12 months. So even for a slow and consistent grower, the company still expands their total sales every single year. And taking a look at their dividend, right now the yield comes in at 1.55%. They have a payout ratio of 37% of their total net income, so it's low and sustainable for the long term. And they don't grow that dividend very fast, but you are getting a 2% raise every single year to match inflation over the longer term. And we can see their current dividend growth streak sitting at 47 years is extremely impressive, and by 2025, they will become a dividend king. And taking a look, this company's dividend is also considered safe as well, coming in with a 78. So over the shorter term, another company we don't really have to worry about a dividend cut to come anytime soon, and I'm sure Walmart will continue to grow it for 3 more years at least and become a true dividend king. So they were the second brand to take a look at for your portfolio if you want some exposure to long-term dividend growers that will soon become dividend kings. And now on to stock number 3, we have ticker KMB, which is Kimberly-Clark. The company currently trades for $132 per share. They're actually down 4% on the 1-year chart, and they have a market cap at $44.2 billion, a forward PE of only 18, and a nice high dividend at 3.43%. And something very interesting to note about Kimberly-Clark is that this is one of the oldest consumer companies on the public market. They were founded back in 1872, and they've been operational for close to 150 years. And currently, you can find KMB products in 175 countries all around the world, with a quarter of the world's population using a KMB product every single year, which is absolutely phenomenal. And we can see they own some of the well-recognized brands like Kleenex, Huggies, Pull-Ups, Cottonelle, Scott's, and many more. So these are consumer products that no matter what's going on in the economy, we're in a good time, a bad time, a major recession or depression, individuals will always have demand for these types of products. And with this type of goods being sold by KMB, it leads to consistent revenue every single year. And we can see over the past 5 years, their total sales have hovered between $18 and $19 billion. So not a lot of growth, which is one downfall, but for a boring, consistent player, KMB is definitely a brand to take a look at. And onto the dividend, the company has a current growth streak of 49 consecutive years, and since 2011, their CAGR sits at 5% per year. And they've been paying out a dividend for 87 years overall, which is incredibly impressive. And at this current point in time, the yield comes in at 3.43%. The payout ratio is still sustainable at only 62% of their net income, so they have a lot of room to continue to reinvest back in the business, pay down debt, and try to fund future growth to increase that revenue. Plus, it leaves them a lot of room to also grow that payment for many years to come. So another brand very close to becoming a dividend king, and I'm sure they'll hit that feat in 2022. And also their dividend is considered very safe, coming in with an 88, and I do own a small position in KMB in my personal portfolio as well. It makes up 2.7% of the total value. I'm somewhat flat, only up 2.2% overall in this position. I own 21 shares, and my annual income is $95. So a nice boring consumer company I do own in my personal portfolio as well, just for greater diversification across the worldwide consumer sector. So KMB comes in at stock number 3, and now moving on to the fourth and final future dividend king we're going to take a look at in this episode. Its ticker MDT, which is Medtronic. The company currently trades for $127 per share, and over the past 12 months, they are up by 30%. And right now, the company has a market cap at $170 billion with a dividend yield at 2%. And over the long term, this healthcare brand has provided some great share price appreciation. And for the past decade, they've grown 210% overall on a nice consistent upward momentum. And we can see that during their latest quarter, total revenue grew 32% year over year and a fast recovery from the pandemic-ridden prior year. And their EPS was up 159% year over year as well. So the company has posted a very strong quarter for the past 3 months and has raised their guidance for the rest of the year. And they're now forecasting 9% organic revenue growth, which is absolutely phenomenal for a big name company. And they're forecasting around $33 billion in total sales. And earnings per share is expected to come in a range between $5.60 and $5.75 for the next year. And taking a look at the dividend, a current yield right around 2%, a payout ratio like all the others in the video, very sustainable, making up around 45% of their total net income. They grow that payment annually, averaging around 8.83%, and their current dividend growth streak is at 42 consecutive years. So not as close to 50 as the others in the episode, but coming up on that landmark over the next 8 years, which I do believe they will achieve. And taking a look at the dividend safety score, coming in at a 99, the highest score possible, so it's extremely unlikely that we see a dividend cut coming from Medtronic anytime soon. The healthcare industry is kind of sticky, it will always be in demand, and especially with medical equipment, which is what Medtronic provides, there will always be a growing demand for more and more services as the population continues to age. So they were the fourth dividend company worth taking a look at for some growing passive income. And now as we wrap up the video, we went over 4 dividend paying stocks who have been growing their annual payment to investors for over 40 consecutive years. They are very close to becoming a historical dividend king, and that's absolutely incredible. These are some of the strongest businesses in the world. They're very boring, often get overlooked by younger investors, but it doesn't hurt to invest some of your capital into some boring companies for slow and consistent growth over the longer term. Not every investment has to be flashy, and owning some boring blue chip companies will create some nice balance in your portfolio and still yield some great returns for many years. So I want to thank you for watching to the end. Please hit that like button and subscribe if you haven't done so already. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. So please hit that like button, subscribe for the daily videos, and I will see you in tomorrow's episode.